what is your current assessment of today's global economy and financial markets?
So I think the underlying problem is that we've underinvested in a number of real world systems, right? So commodities, especially energy, as well as we've, highly diversified our supply chains globally. Basically, we've optimized for efficiency over resilience, and we're kind of getting the call on that setup, right? So we're kind of quickly finding out the world's not quite as peaceful as we thought it was. And that if we underinvest in some of these natural resources, we're going to be short them when the time comes. And so we have these real world constraints, and combined with the fact that we increased our currency supply by quite a bit, we've run into inflationary problems. And the Federal Reserve and other central banks can't print more of those real goods and services, but they can try to curtail demand. And so right now they're doing the best attempt to jawbone demand lower, while trying also to avoid an outright recession. And historically, the Fed's ability to do soft landings is not very high. It's a very kind of low, maybe a couple times they almost did it, but for the most part, it's like an on or off switch. And so right now, I would say we're basically going into a economic deceleration in an otherwise stagflationary environment. And so I think this is a rather defensive. You generally want to be more defensive at this time and focus on things that have real world utility.
So we sort of have more currency units, chasing fewer things, and I'm saying fewer things because we are having some big supply chain shortages still lingering, and so to deal with that, because the central banks can't print up more real things, they're trying to drain the pool a little bit to get the inflation under control. You said we're going into an economic deceleration into a stagflationary environment. I think I got that correct. And I'm just curious, we'll get into this in the specific questions in a second, but stagflation is when inflation remains hot, but economic growth gets stagnant. If you think we're hitting into a period of stagflation, how long do you think it will be? In other words, how long does it take for stagflation just to become recession, because finally demand destruction begins to bring the inflationary prices down, but you're stuck with the stagnant economic growth?
Partly that will depend on policymaker decisions. But for example, if you go look at the 70s, even during the economic slowdowns, the recessions in the 70s, you still generally had pretty high inflation. You just had, maybe you took the edge off inflation compared to some of the most inflationary periods. And so my general view is that this whole decade is probably going to be somewhat stagflationary. Basically, we're going to have supply side problems, particularly on the energy side, I think, for quite a while, for years at least. And whether or not we, bring inflation down to, let's say, official CPI down to 6%, 5%, 3%, depending on how low we go, that partially depends on how forceful central bankers are willing to be and how to what extent politicians are able to deal with recessionary conditions. Because right now, the clear, if you ask people out there, what is the biggest problem, they'll say inflation. And, right now we're starting to see kind of a slight uptick in initial jobless claims. And so I think, to the extent that they try to continue tightening by pulling back on stimulus and tightening monetary policy, I think we're going to see a shift towards a weaker job market, and you kind of can turn an inflationary problem into an unemployment problem. But you can also have both at the same time. And so I think that there are scenarios where they could cause like some sort of deflationary bust temporarily. Like you could kind of cause a severe contraction. But I think that unless they push it that far, I think we're in more of this kind of malaise where energy prices are high. They're kind of the constraint. And they can be in a big choppy range if you're really trying to hold demand down, but it's like holding a volleyball underwater, right? It's, holding a beach ball underwater. I would use the analogy that we're kind of rounding a corner going very quickly, where we see the long run where we're going, which I think is much higher energy prices, much higher inflation. But right now you have to kind of put the brakes on and slow down and be careful with your investing around this corner, because this is the period where central banks are trying to fight back. And so for the next several months, as long as we're going to experience quantitative tightening, raising rates, and no new stimulus from Congress and things like that, I think it pays to be defensive around the margin and to look towards maybe some degree of disinflation. Not necessarily that inflation will go away, but that we might not keep going up at the same pace that we were. at least that, especially outside of energy. And so that's how I play this. Basically, I think that we can almost have a barbell approach where you stick with energy types of investments, but then you also look at some of the more defensive types of things like cash and even treasury bonds.